Hey everyone, it's Rob B here with Rob D, and you are listening to the Property Podcast. There are things that are holding investors back that absolutely shouldn't be. But there's also a list of things that you should be concerned about as a property investor, and some people aren't. So we're going to go through both lists today to make sure you're not wasting your time worrying about the wrong things and putting your focus on the things that really matter.
Welcome to the Property Podcast. Thank you for joining us. In case you don't know, we run a business that buys more than £100 million worth of property every single year for our clients. You can find out more about that at propertyhub.net/invest. And as a result of doing that, we and our team hear all the worries that investors have. And so in this episode, we'll be splitting out those that actually matter from those that don't. All of that coming up.
So it's time for our news story of the week now. And this news story has probably got onto the radar for you because there's a lot happening in the world right now, but we still want to bring you the industry news and keep you on top of what is happening in the world of property. And this week, we need to bring you up to speed on what John Lewis have done, or to better phrase it, are not doing. Because you may remember a few years ago, to some fanfare, John Lewis announced that they were going into the world of build to rent. So not just satisfied with owning an upmarket supermarket and some wonderful stores, they decided they wanted to provide homes as well. But Rob, it seems that after all the noise and fanfare, not a lot has actually happened and may not happen ever at all.
Yeah, to my great disappointment, because living literally inside a John Lewis was my middle class dream. But sadly, it looks like it's not going to happen because they have scrapped plans to build 1,000 rental homes, according to a story in The Guardian. And that was meant to be the first 1,000 of 10,000. But now, like you said, there's doubts about whether any of it is going to happen. What appears to be the case is that they had partnered with Aberdeen, who are a big asset management firm, to raise some of the funds for this venture, and they've not had a lot of interest. And what the John Lewis spokesman has said is that we made this decision in a very different financial environment with more stable investment returns, lower borrowing costs, and more affordable costs to build homes. He goes on to say, unfortunately, the current climate, higher interest rate, inflationary pressures, and a more cautious property market means the model no longer meets the partnership's investment criteria. So that's bad news for me, Rob, bad news for John Lewis, and bad news for the government as well, because remember, build to rent is completely new supply. This is not just stock shifting between owner-occupiers and investors. This is new stock that would not otherwise exist. And if companies of this size and strength can't make it work, that's not looking good for the government's plans.
It's not, but it's not just John Lewis. Since interest rates have gone up, a lot of build-to-rent operators have pulled away from the market, and particularly away from what you would call secondary towns and cities. So there was a time when they would build and commit to anywhere pretty much, but now they are being super fussy because there's a lot less players in the market. What's going to be interesting to follow is with interest rates on a downward trend now, whether they will return to the market. My guess is yes. But it's not like flicking a switch. Remember, John Lewis made this announcement a few years ago and actually haven't delivered a single thing yet. So if everyone comes back to the market and says, we're back in, you still got to get those funds up and running, then decide which projects you're going to invest in, and then those projects be built out. So even if interest rates were cut dramatically this year and borrowing costs suddenly made sense for this sector, it would be quite a few years before the stock hits the market again. So it's a really interesting story, and we'll absolutely keep you updated on this as more is announced. But the real time to come back to this is when interest rates have come down a bit further to see who's entering back into the market and what their plans are. And of course, on the Property Podcast, we'll keep you updated on all these type of things. And make sure you join us next week where we have the market update, where we'll tackle everything that's going on in our industry and sometimes and beyond. So make sure you're there bright and early next Thursday for next week's episode.
We've been doing this for a long time, and we must have spoken to hundreds, if not thousands, of investors over the time we've been doing this podcast. And from those conversations we've had, from the questions we get into Ask Rob and Rob, we know that investors have worries. And that's normal. You're investing a lot of money in a single asset. And if you're doing it for the first time in particular, it's scary. Worrying is normal. The problem is that in our experience, most investors are misdirecting their worry. They're losing sleep over things that really don't matter, and at the same time ignoring things that they should actually be thinking about a lot more. So in this episode, Rob, we're going to try and set people straight. We're going to run through the things that investors should not be worrying about anymore and point them towards the things that really are worth thinking about.
Yes, this might be one of those episodes that if you get worried about your portfolio from time to time or a particular investment you've got, you might want to bookmark and come back to. There are things that you should be worrying about and paying a lot of attention, which we'll come to. But let's start with the things that really are taking up too much of your headspace that really shouldn't be. And the first one, I see this so often, is the first year's numbers. So what do I mean by that? When you get a new investment property, people obsess about its performance at the very, very beginning and can write an investment off that could be absolutely fantastic in the early days because it's not started as strongly as they'd hoped. So for example, when you get a new investment property, you're almost certainly going to have a void period at the beginning. You're going to get the property ready for rent. You're going to market it. It will take time. There might be some competition on the market. And normally, you see the first time you get a tenant into an investment property, it takes a bit longer. Because in the future, you have notice of when your tenant's going to leave. So you can prepare the property for your next tenant and advertise it in advance. But it's a lot more difficult to do that when you're buying an investment property because you haven't got the keys yet. You can't get in. You can't get it tenant ready. So there's that longer void period that tends to happen at the beginning. And this seems to stress a lot of investors out, but they shouldn't be. And something I always say to these investors is when you look at this investment in 10 years' time, will you be worried that it took you 6 to 8 weeks to let this property out? No, the answer is no. But it feels like a big, huge thing at the beginning of your investment because you've just committed to it emotionally. You've gone into this deal. Mentally, you've committed everything. You've put a large chunk of money in. So all those emotions are there and you want it to be perfect. And you might have a partner that you've convinced or taken on the journey with you that you said, this is going to be great. And you feel under pressure for it to perform from day one. But that is the wrong expectation because it almost certainly will not happen that way. And that is one way people misjudge an investment. Happens a lot. So that's why we've started with that. But it's not just a void period, Rob. People get really, really hung up on the numbers of the first year as well, like the yield, for example.
Yeah, you see this a lot. So maybe you thought you were going to get £1,000 in rent, but actually the first couple of offers you get are at £950. It's like, what? I thought I was going to get £1,000. But again, in the long term, it just doesn't matter. Often, especially if you're buying in a block where lots are completing at the same time, there's going to be more competition that first year than there will be in future years. And also, like, markets do weird things. Depending on the location, there are times of year when the market's a bit quieter than at other times. If you happen to complete at that time, then you might be coming into a softer market. It doesn't make any difference to how your investment's going to perform over the long term. You're also highly likely to have unexpected expenses. Even if you've done a complete refurb yourself and you think that everything's perfect, someone is going to move in and they're going to spot something you've missed. So you probably will have more maintenance in that first year. But oh no, this is more than I had in my spreadsheet. It doesn't matter. Put it all together and your first year is going to be your worst year. It rhymes, so you know it's true. but it's true. You've got to zoom out and think longer term, Rob, and put it all into perspective, like you said.
And there's another mistake with yields that we'll talk about in a moment. But before we get to that, though, let's move on to another thing that people worry about, which is timing the market perfectly. This is the biggest excuse or story that people use to comfort themselves for why they haven't invested yet. Oh, I won't now because, and then fill in a reason. So it could be an economic event. It could be an interest rate rise or cut, whatever, fill in the blank. There's always something going on in the world that will give you a perfectly good reason not to invest. People may believe, oh, the market's going down, so I'm going to wait another 6 months for that to happen. It might happen, but it might go up. Those things happen. I've had that very thing happen to me with shares where I've gone, oh, I'll wait till it hits this price, even though the value was quite good and it didn't get as low as I wanted, and then it's rocketed up since. So I've seen the value in an investment, but because I waited for that perfect opportunity, I didn't get any opportunity. And people do this with property all the time. There's a golden rule that time in the market always beats trying to time the market. And it's a golden rule for a reason, because it's true and it makes sense. It doesn't matter if you buy now and the market dips 4%, because again, go forward 10 years, that 4% will be a blip in your story. It does not matter. You're still going to get rent coming in. You're still going to be making a profit month in, month out. So don't worry if the market even dips a bit after you've purchased. Just look at the market conditions today, look at the deal opportunities that you have and go, is this a great deal in front of me? Is this going to be a great deal in 10 years' time? Not 6 months' time or 12 months' time. Will this be a deal, an investment that I'm really happy with in 10 years' time? That's how you should frame this.
Yeah, you said it, Rob. There was something that could affect property prices. But again, the solution is the same as it was before. Zoom out to the big picture. Let's move on to our next one, which is another biggie. It's another one that we've talked about before. People worry about having mortgage debt at all. People would rather buy with cash. I think there are a lot of investors, the majority of investors, see a mortgage as a compromise. If they had the cash, they would buy it with cash. But no, a mortgage is virtually the entire point of investing in property. Now, of course, that's not saying leverage yourself up to the eyeballs, take a load of risk, be making a loss each month and hope that capital growth will bail you out. Absolutely not. But a sensible use of leverage is the big reason for investing in property rather than anything else. Because again, we've said it before, but this is super important. If you look at the long-term performance of property and the stock market, they're really not that different. So given that you could invest in the stock market and get roughly the same return for less effort and better tax treatment, why would you not just do that? Well, the answer is that thanks to a mortgage, you can buy 3 or times more property than you would stocks, and therefore, obviously, they're going to do better. And that's a mindset shift I think is so important to make, because there is no absolute number of too much mortgage debt. And having your mortgage debt stay the same year after year after year, not paying it down, is not a problem. It's actually helping you out. As long as you're making a profit each month, you've got a margin of safety, and there's no point at which you're forced to sell. As long as you're resilient and nothing's going to force you to sell at the wrong time, then mortgage debt is, yes, something to take seriously, but definitely not something to worry about.
Next on the list of things that people worry about is the collection of things around new build properties. Now, at Property Hub Invest, we do new build properties as well as properties that have been built. It's just properties that are in really good condition. But because part of the portfolio mix that we acquire for our investors is new build, we see a lot of mistakes being made there, or a lot of things being worried about that really shouldn't be. And this is an opportunity to address that. First one is plot selection. When we make an investment, it could be 50, 60 units from a developer, which then means that our investors have a choice of plots. Now, the amount of time you should take picking your plot should be short, because the reason why is you're not going to live in it and somebody else will. And your subjective views on what makes a nice place to live in is going to be different to someone else. So sometimes it might be the floor that it's on, if it's an apartment, or if it's a house, what way the garden is facing, or the size of the garden. Some people think, oh, I want the biggest garden, but a tenant might not want to look after that garden. You've got to remember that you are not living in this property. And I've got a prime example of this because I've made this very mistake myself many, many years ago. Because when I had the opportunity to pick an apartment in Leeds, because I had the pleasure of being able to go first to pick, I did. And I spent a stupid amount of time picking that plot, hours upon hours. And many people will know me that I do like to research things, but I'm also capable of making a quick decision. And this is one of those times where I really shouldn't have spent so much time researching, because I picked what I believe to be the plum plot, the best unit available in this block, because I had first pick. So when it came to completion, understandably, being a so-called expert, expected my property to let first. So the first block got let, not mine. The first half got let, still not mine. Another block got let, still not mine. Mine was in the last 20% to get let. There was me, a supposed expert, picking a unit that I'd spent hours selecting, and it was one of the last to let in that block. I've never spent that sort of time again. In fact, now I ask the Property Hub Invest team which one I should take, because it's a waste of time. They've looked at it, they'll give me some advice, they might give me a couple to pick from, and I'll just go with it, because it does not make sense to spend time emotionally feeling your way through a plot selection list to go, oh, this is going to be the best unit because. The bit after because is your preference, not the market's preference. And you may feel you'll be able to assess the market better than others, but just be for the person who wants the large garden, there's somebody who wants a smaller garden. For the person who wants to be high up, there's somebody who wants to be low down. There's a huge tenant market out there, and you do not need perfection. You just need to get a great deal, because the difference you're picking at that level is marginal. What's more important is the deal a really good deal? Is the area a really good area? The plot selection is a marginal decision.
Yeah, there's so much randomness in property as well. But you can have the property that's overlooking the bin store rather than with a beautiful view, but you just happen to get the world's best tenant moves in there and stays there for 10 years. You just don't know. And so that's why it's just not really worth worrying about. But Rob, that's not the only thing when it comes to new builds that people worry about too much.
Yes, another one that happens a lot actually, but I think it's just a lack of knowledge, so it can be quickly addressed here, is that people get concerned when there's a snagging list when you complete on a new build. A snagging list is a list of faults with the property when you complete. So it may be the door is chipped, the tap is a bit loose, the grouting on one of the tiles is messy. It's a list that will be given to you. Now, when you get this list, if you have a list of snags, you have not been unlucky. You've just gone through buying a property, because those snags are normal. I've never seen a property complete without a snagging list. It's part of the process. Now, if you've never done a new build property, you might be thinking, wait a minute, so I buy a new build and I get an imperfect property. No, what will happen is that snag list will then be addressed by the developer. If you're buying yourself, then you can liaise with them and go through those snags and get them to complete it. Or if you buy with someone like Property Up Invest, we'll do that on your behalf. But the point is, it's normal. But I think because it's something that's not really talked about a lot, when people experience it for the first time, they're caught off guard and they're surprised, but it's normal. So that's another thing that people worry about. A bigger one, though, that is another huge mistake, like plot selection, is yield selection. So people pick their plots and they might go, right, I'm going for this one over that one because it's southwest facing over northwest facing, wherever. As I said, that's a mistake. But the other mistake that people make is they don't even look at the plots at all, which is fine, but then they'll look at the yield and they'll go, wait a minute, this property here has a 5.9% yield and this one has a 6.2% yield. I'm going to pick the 6.2%. That's daft. So let's say the difference of that is £50 a month. Now, at £50 a month, you might be thinking, well, yeah, of course I want that extra £50 a month. Across a year, that's £600. But let's be real. Is £600 a year going to change your life? No. But I've seen people go, oh, I want the 6.2%. And when that's no longer available and they've been offered the 5.9, they've turned it down and gone, I don't want to go into it anymore. That is crazy. If you have done the research, looked to say, okay, this is a great area, this is a great development, this is a great investment, but then you've sacrificed the ability to invest because you wanted the best yielding property in that list, that is nuts. Because the amount you've just cost yourself by not investing and maybe waiting another 6 months, or maybe you never end up investing, is huge. That is criminal. You think you are doing well by not sacrificing the £50 a month and you're sticking to your principles and that's the one I want, but you've just cost yourself so much more. If you had a £200,000 property and the market just grew by 1%, that's £2,000 in capital growth. 1% is way below average. We've had a lot of bad years recently, but we've still done better than 1%. And that's not accounting for leverage or the rental profit you would have got as well. But not being in the market because you wanted the very best yield, you've earned zero. So it is absolutely nuts to me that people get so wound up and obsessed with picking something because it's got the very best yield in a development or block, when for a marginal difference, they can still get in. I bring it up because it happens and it's something that is a bit nuts. Something else, Rob, that people will look for as well, and they will be looking for a long time, is the perfect investment.
Yes, I think sometimes this is an excuse, if we're honest, because investing is uncomfortable, it is scary, and if you can always find a reason to say no, then it means that you don't have to go through that discomfort. But it could also be just having the bar set way too high. It was you, Rob, who said this many, many years ago, but it continues to be true today. If you're looking for perfect, you'll be looking forever. There is no such thing as the perfect deal. There is such a thing as very good, and very good is great. But what people do is that they will pass over very good because it's not perfect. Whereas in reality, you're always going to be compromising somewhere, and there's always going to be some potential concern. And again, just like we were talking about before, if you keep passing over very good, looking for perfect, how much have you cost yourself? How much risk are you actually taking by staying out of the market for all this time while you're looking for something that will never arrive? And I get it's really difficult because something else that we say is you've got to be picky. You need to look at a lot of properties. You need to be getting yourself a deal. And that is true as well. I think on the whole, people should probably be looking at and offering on and rejecting a lot more properties than they are. You do see a lot of times when people will go and view 3 properties and then end up buying one of them. That might not be enough. But at the same time, you see people go the other way and keep on passing up opportunity after opportunity because there's some kind of compromise or there's some kind of very minor concern. But you do have to find that sweet spot in the middle. Because again, bring it back to the big picture, and will it matter in 10 years? If you make an absolute dog of an investment, if you buy something in a bad area where there's no demand, where it's falling apart and there's going to be constant maintenance, and yes, I have done this, and so I know it's true, that will matter in 10 years. So don't do that. But at the same time, what's the difference between an investment that performs pretty well and an investment that is absolutely stellar? It's not going to be that big over 10 years. And obviously, you'd make the incredible investment if you could, but no one can do that every time. And the crazy thing is, a lot of the time when I look at my portfolio, the ones that I thought would be absolutely unbelievable have turned out to be, pretty good. And the ones that I thought were just okay have gone on to be the best performers. So you can't even predict it in advance anyway, or at least I can't, and I supposedly do this for a living. So looking for perfection really is a trap because it holds you back from taking action.
So there you have it. You've got a list of things there that many investors, a lot of investors worry about. And think about it. Which of those have you worried about in the past or even worried about today? You start striking those off your list because that list we've just given you of things not to worry about is from a lot of experience and a lot of personal mistakes. We've learned the hard way, or we've seen other investors learn the hard way, and we can bring you those lessons. There are things that you should be worried about as a property investor, and hopefully these ones are obvious to you, but we'll quickly run through them so you can spend, if you like, losing sleep over these things if you've got any of these wrong. So let's give you a quick list of things that really should be top of mind when investing and potentially worrying about if you haven't got it right. So first is lack of cash reserves. You do not want to invest in a deal every single penny you've got, because when you invest, we've already talked about, you'll expect a void period. You'll expect things to go wrong. Your first year numbers will be a disappointment if you've never invested in property before and you don't have that experience. So with all that in mind, there's going to be hidden costs at play. If you've got £100,000 to invest and the deal you go into has taken every single penny of that £100,000, and then suddenly there's an unexpected bill of £5,000, what are you going to do? So you always should have a cash pot, a reserve, a rainy day fund, if you like, to help with your investments if something goes wrong. It doesn't need to be a huge pot, but the pot does need to exist.
Yep, that's a big one. And another one, which I have been guilty of in the past, is not worrying enough about whether you're charging the right rent. And this has become a real theme over the last few years for various reasons, but it's always been the case. Supposedly, investors are greedy, they're rinsing tenants for everything they can get. In reality, yes, I'm sure some people do that, but a far bigger proportion of investors let the rent stay where it is while market rents keep on drifting upwards. And it's understandable why they do that. They're making enough, it's fine, they don't want to lose a tenant, don't want to have an awkward conversation. But the trouble is, 5 years later, this huge gap has opened up, which then gets very difficult to fill because it seems like a huge leap for the tenant to make. And now it's even worse because with the Renters' Rights Act coming in, it's going to be possible for tenants to challenge rent increases. And even if your rent increase is totally reasonable, because all you're doing is pulling it back up to where it should have been after multiple years, the fact that the jump is so big makes it far more likely that the increase is going to be challenged. So once the Renters' Rights Act comes in, you'll have the ability to increase the rent once per year. And this is something that you should be spending some time on. Just once a year, figure out what should your rent be. And if it should be higher, consider having that awkward conversation and consider addressing it at that point so it doesn't become an issue later.
Another thing that you should be giving serious consideration to is your tax structure and getting it right from day one. You don't want to start investing, get yourself a few properties and realize you've made a mistake when it comes to tax. Now, once you've made a decision of the right structure and the way forward for you, it's really easy, whichever path you take for the majority of people. You need to understand what your end goals are, what your current situation is now, and what will be the best tax structure for both of those things. Now, this is a big subject and we can't get into it now, but we'll link to one of our YouTube videos on tax to help you get a better understanding of your options, but you will probably need to speak to a tax advisor to make sure you are definitely getting it right. You might be able to figure out by yourself, once you've watched the video, but our recommendation is watch the video, educate yourself, and then speak to an advisor. But getting it right is important.
And finally, this is a huge one. Investors do not think enough about the value of their own time. So you see it in the case of refurbs. So you'll do some refurb and say that you've added some value. That's great. But if you factor in your own time cost, how much value have you really added? And you see it in day-to-day management. Someone doesn't want to pay a letting agent because my rent's £1,000. That's going to cost me £100 a month. Okay, but how much of your time are you spending chasing up payments, ringing around contractors? If you put a value on your time, it flips the equation completely. And obviously, this isn't true for everyone. And I recognize that while I don't, some people actually enjoy doing this stuff. And so they think about it in a different way. But let's face it, these days, if you're investing in property, you've got to be a high earner. You'll have something that you do that brings in the money that allows you to invest in property. So the best thing you can be doing with your time, apart from having fun and seeing your family and all that stuff, the best thing you can be doing with your time work-wise is doing more of that thing, because that is what will bring in the money to get you to your next deal faster. That is the engine. That is the engine of growth for your portfolio. That is what will allow you to not just have a single property, but to build a portfolio over time, which over 10 plus years will make a giant difference to your life. You will inevitably have to spend some time maintaining what you've got, but that's not really adding anything. You want to minimize that as much as possible. And Rob, we could do an entire episode on this. Maybe we should. But this is a huge point, and it ties back into all those things we talked about earlier that investors shouldn't be worrying about, because all the time that you're spending stressing out about those things is time that you're not spending doing the things that actually grow your portfolio.
Exactly. And growing your portfolio is the aim of the game. So we're not saying don't worry about anything, just invest and smile. No, there are things that you should treat very seriously when you become a property investor or want to become a property investor. But there's a lot of noise out there that can feel big and scary. But hopefully now we've gone through that list with you. When those things pop up and arise, you'll remember back to this episode. And that's why I said bookmark it if you're a bit of a worry bum, because this episode is one that you can come back to and go, no, that's right. I've heard this. I'm approaching it the wrong way. I need to look at this differently. And that's all this is about, is taking a different view. For a lot of these things, it's like, will I worry about it in 10 years' time? Your first void period? No. Getting your tax setup right? Yeah, maybe you will if you've got that wrong. Use that framework and make sure that you pick the right things to give your time, energy, and focus to, and ignore the rest of the noise. That might seem big at the time, but it really isn't.
Okay, it's that part of the show where we try to squeeze in a little bit of extra value before we end in the form of How Extra, an extra tool, a tip, or a resource. This week, Rob, a bit of an unusual one, but something that we're both using right now.
Yes, as we record this very podcast, we are both standing up, not next to each other. We do this remotely. But what we are doing is using our stand-up desks to record. And Rob, you've had a stand-up desk for years. A few months ago, I invested in a stand-up desk and I've just really enjoyed it. I've used stand-up desks in our office before, so it's not new to me. But at home, my room was furnished in a certain way. It had a sit-down desk like the majority of people have. And it was fine, but I felt so much better moving to a stand-up desk. So I thought we've got to talk about it on the podcast and remind people how great they are. One of my goals is a bit of a sporty goal this year. So I've had to do a lot of work on mobility and unlocking those hips, which have been severely locked after lots of sitting down over the years at a desk. So standing up is certainly helping with that. But regardless of your mobility, I think the energy that stand-up desk gives you is completely underrated and not talked about. So if you are in the market for a desk and a desk for you to work at, I would highly, highly recommend you look at a stand-up desk. My desk is an IKEA one, the top IKEA model that they do. The quality is absolutely fantastic. It's really, really good. It's got all the built-in power points. It's got the presets. It's all electronic up and down, super stable. You can spend a lot more money if you want, and you can go cheaper if you want as well. But I was always convinced, but doing it full-time with a stand-up desk now, I'm questioning why have I not addressed this sooner. A great investment.
Yeah, and the next level beyond that is getting one of those walking pads to put under your desk so you can get your steps in while you're working. I haven't gone there yet. I've been tempted. I have done a little bit of looking, but that's the next level.
Yeah, I've looked at the treadmills as well, but I've held back so far.
If I go there, I might see if I can take you there with me, if only so I don't feel like such a weirdo. But stand-up desks, definitely recommended. And with that, we will leave you for today. Hope you're leaving this episode with a weight off your mind. We've given you a whole list of things you have now had permission not to worry about. So with that lightened load, enjoy the rest of your week, and we'll see you soon. Bye-bye.
Bye-bye.